Hello. I'm Josh Stein. I'm the CEO of Harbor. Harbor's a blockchain startup designed to tokenize traditional private securities. So if you think about things that you own and your property interests, things that are private securities today, equity in a company, equity in a building, other sorts of private ownership, you can put that on the blockchain, tokenize the property interest, and then you can trade that in a way that you can't today. What I want to talk a little bit about is that technology that we've set up to allow you to compliantly issue and trade crypto securities. You can use that same technology for ICOs, for what we call utility tokens that the SEC is saying you have to treat as a security. So I want to talk a little bit about what the SEC is doing, building on what Jason and Kurt talked about, and then talk about a path forward through the regulations where we can still follow the SEC's requirements and yet still get the kind of distribution and trading on utility tokens that we need for the decentralized apps we're building in the ecosystem. So everything that Jason said was true, including and the. The SEC is in the middle of a crackdown on ICOs and crypto issuers. They're focusing not just on the people that have issued the utility tokens, they're focused on their lawyers, and they're focused on the major investors who bought at a deep discount and flipped their investments. In talking to you today, I'm not trying to debate whether that is right or wrong, but it's simply a fact that we have to deal with. And I think there's been a lot of angst and a lot of folks who think, well, that's the end of ICOs, that somehow we have to follow securities laws, that we can't get what we need, and that's actually not true if we have the right technology and how those tokens trade. Where the SEC is coming from is these ICOs have been marketed like securities. The investors come in early, they buy at a deep discount, they flip it, and nobody's talking about these in terms of Chuck E. Cheese tokens like Jason was talking about, in terms of microcurrencies to pay for the use of software. Instead, they're talking about them in terms of the speculative or investment potential. So if it walks like a security and it quacks like a security, it's going to get treated like a security. So what's the way through these regulations? I think we have to back up and see what's the SEC's mission, why are they there? The SEC is a threefold mission. It's to protect investors, is to facilitate the formation of capital, i.e. to enable the investment that drives our economy, and to ensure orderly markets, which is the buying and selling of these tokens. And if we focus on those same things and navigate the rules, we can get the utility tokens we want out there. So if you treat utility tokens like securities, what's that mean? It means that when you initially sell them under what's called Reg D, you sell them to accredited investors. And that's what a lot of folks are doing today. Those are a lot of the initial sales to the large investors at steep discounts. It means then that under the rules on trading them, you have a staggered period of holding periods. You've got a 90-day holding period, and then under what's called Section 4A7 exemption, you can trade those tokens in the US amongst accredited investors, but you have to make certain information disclosures. The company that sold those tokens has to provide certain basic financial info, so that way people know when they're trading those tokens what it is behind it that's backing it up. And then after a year and a day, under what's called Rule 144, those tokens can trade freely, whether it's amongst accredited investors or any investor in the US. And so you might say, well, that's a huge bummer. I can't get in early on the ICO. And whether you agree or disagree, the theory behind it is that early on, when there's not much known about the protocol, there's not much known about the people behind it, accredited investors have either sophistication or, more importantly, the financial resources to lose it all. And then those disclosure obligations allow people over time to understand what they're getting into. And after a year and a day, actually, we all as a crypto community should have a pretty clear idea of, is their product being shipped? Is this token going to have real utility? Is it something that I really want to invest in? And at that point, it actually can trade relatively freely. So from the point of view of us as investors, it may not be ideal. We're not getting in on day one, and we're not sort of buying our Lambos on day two. This is a tough crowd. I thought I'd get a smile for that one. But what we can do is stage the liquidity and get more information over time so that we as a community can make the right judgments on what we put money into in order to drive forward the promise of crypto, which is not sort of speculative wealth. It's really driving these decentralized applications that we couldn't have before the blockchain. And then from the point of view of the issuer, what do you want to do? You want to raise investment dollars. That's part of what makes it a security. And you want to get the token out there as widely as you can. And with Reg D, you can get out there pretty widely over time. And if you really need to get the token out there to raise investment funds, it's going to take you a while to build out the protocol and build out the functionality. And so you can actually meet the requirements of the securities laws and get the investment capital you need. And they also have what's called Reg S, which is where you sell to overseas investors. And most overseas jurisdictions, but not all, treat utility tokens as utility tokens. They don't treat them as securities. And there they can trade freely. And again, that's more information for investors here in the US. But in order for all that to work, you need a technology underlying it that treats it like a security. And so our thesis is you have to have a control at the token level to control the who, the what, and the where. So you have to have a control that that token only trades in the US amongst accredited investors, that those investors have been vetted for what's called know your customer anti-money laundering compliance, and money laundering is a real concern. And that they are, in fact, accredited investors when it's required to go amongst accredited investors in the US or in those certain jurisdictions overseas where it's required. So you got to control the who. You got to control the what, the trade itself, that's complying with the holding periods, that it may have to comply with certain other rules in other jurisdictions. And that's controlling the where, that's only trading in proper exchanges that are licensed to trade it and that are following the restrictions. And so if you can control the who, the what, and the where, which you have to do on the token level, you can treat these utility tokens, you can get the float you need. And that's what Harbor is designed to do, is for those things that are unambiguously security. If you tokenize the shares of employees in a company, if you tokenize the owners of real estate, that then you can trade those compliantly. And I think when we think about property interests in the real world, you can get some very interesting things. Our goal is to make issuing and trading private securities as easy as sending an email. And just like email was to snail mail, tokenized private securities are going to be to traditional paper securities. Public securities, where you're on the New York Stock Exchange or the DAX, those have a high degree of liquidity. You can invest and get in and out very easily, but the problem is it's so expensive and such a long timeline, it's very difficult to raise capital. If you're not raising a huge pot of money, if you only want to raise $5 or $10 million, an IPO doesn't make sense. So what you want to do is you want to marry the speed, the ease, the low regulatory burden, the low expense of private placements, but you want to get the liquidity, you want to get the ability for investors to come in and out that you get with the public markets. And you can combine the best of those both worlds if you tokenize and you allow those things to trade freely. So what you could do, for example, is take a private real estate fund. You could issue tokens instead of paper securities. After a brief holding period, buyers and sellers who today in the paper world can't find each other, in a tokenized world can find each other very easily on these decentralized exchanges, then they can trade freely. You know the cap table is always correct. You know what your ownership is because you can see it on the blockchain. You can trade without counterparty risk because of the blockchain. And so you can get investors from around the world, investing around the world and doing it with confidence because you enable this blockchain technology and you get a high degree of liquidity, and that will drive the investment that we need to do things like build more housing, build more companies, and power the economy the same way we do today. Thank you.